But let's go back to an issue we've been talking about for a pretty long time this week, that of currency fluctuations, and not just in Kenya. The East African currencies continue to tumble against the world majors, case in point the dollar. Seemingly helpless situation it has been. Roy Daniels is the head of Africa Trading at RMB. He joins me now. Roy, we've been talking about the situation, and what comes to mind is the Ugandan currency, down 21%. How did we get here?
Hi, Bonnie. Yeah, look, it's tough times, I think, through the region. But you know, we mustn't get, as you correctly said, we mustn't get too focused just on particular countries. I mean, it is dollar-led strength. There is the whole Brexit that's hanging over their heads. There is the reaction to the stock markets in China this morning. So all these things combined are putting pressure on currencies all over the world. When we look at the African currencies, we're not going to be spared. Uganda is suffering probably a little bit heavier than most. I mean, it's struggling for donor flows. It's struggling on some sort of strong political stances that it's taken. So when we consider all those things, I mean, they do come home to roost eventually. You know, we can only put a peg in the ground and drive it in for so long before it starts to cause some pain somewhere. So I just think that it's a case of a lack of FDI coming in. One of the key factors for us when we want to trade the market is that we do look at some of the taxes involved, and we don't like those taxes. They impact on the yield of the bonds, so we tend to steer away from those. You know, the less sort of tax and admin complications, the better. Unfortunately, Uganda has those, so a far better market for us, should we be looking to invest into any sort of bonds, would again be the Kenyan market, where we do like those infrastructure bonds.
Roy, these fluctuations have also put a lot of pressure on the respective policymakers in the region. Case in point, the Kenyan MPC meeting yesterday, they decided to raise the rates by 11.5%. Obviously, this will stifle credit. We're seeing a correlation between this sharp fluctuation with some sort of stagnation in growth.
I think when we look at the rate hikes, the last two from the Kenyan MPC, you know, 150 basis points and now again 150 basis points. If we reflect back to when it was really tough times, they went 400 basis points and 350 basis points. So that was a real sort of shock tactic to the market. So 150, I think they're acknowledging that there's a problem with food inflation. They're acknowledging that there's a problem with credit growth. And rather than try and shock the market, they're trying to sort of ease the market into higher rates. Now, I've heard a couple of the guests mention around, you know, the stifling of growth. They don't have bad growth, you know, growth of north of around 7%. So they've got a bit of room to play there with the growth figures at the sort of cost of trying to calm that the credit growth market down a little bit. So I don't think it's too bad. I think some people might say that it's, you know, these things are going to stifle growth in businesses, but you know, there has to be some sort of calm. You know, I think that there's a mixed view of whether we hike rates to try and calm the economy, or we cut rates to just all out promote growth. Now, you do that where there's a lack of growth. I think 7% growth, they've got a bit of room to play with. So we're not too concerned. The currency again weaker through 100. I think the last time we spoke, we were debating whether it would get through 100, and the sort of consensus was that it would get back up there. It hasn't run away. It's been a steady bit of weakness. But again, a weaker currency, balance your current account, promote your exports, boost the agri sector, maybe get some tourists coming back because it's affordable. So there is some good out of it all.
Roy, everyone is agreeing to the fact that probably monetary policy may not float our boat, and people are pointing to fiscal policy. Is that practical? And if indeed so, what are the low-hanging fruits?
As I said, I think that, you know, who'd want to be part of a monetary policy committee or be in a central bank right now? Because every decision is going to be a tough one to make. So I think doing what they're doing, as I said, I think the low-hanging fruit is export-driven. I think if you can lead a bit of recovery in the economy, export-driven, calm the currency down, keep the yields where they are, I think we'll see FDI. I think the market's starting to look a little bit steadier. I think we're going to go through a tough remainder of this year. I think markets remain under pressure, yields remain under pressure, currencies remain under pressure through Africa. It's not only going to be East Africa. And I think probably around end of year, Q1 next year, we might see some calm. We'll see some funds returning back for those high yields.
Finally, Roy Daniels, Gibran, come on. Finally, Roy, when you look at the commodity space in the East African space, we're not doing too well, and there's obviously a lot of concern about government incentives to boost this space. Where do we start from?
I think obviously it'd be from East Africa point of view, it's all in the soft. So I think when we look at some of the export possibilities out of the region, and especially Kenya, you know, the tea, the coffee, they really are the good exports. I mean, our class tourism as a level of export, I know there's people coming in, but to boost those again through these, I mean, it's a sort of security issue that needs to be dealt with. I think the currency is going to make it affordable. When we look at the region as to what the region can produce, I think there's enough there production-wise out of the softs, out of the agri sector, you know, and we hear this time and time again, different regions in Africa talking about agriculture. To boost agricultural sector has to come the spend on infrastructure, bigger ports, faster rail networks, ease of moving goods, better roads, better storages. You know, that has to come together. So when we have the infrastructure bonds and the money goes in the right place to the spend on infrastructure so we can export these soft commodities, I think that's where the boost has to come from.